Welcome back to AlgoBot, the channel where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host here at AlgoBot, and today we're putting a strategy called Shelf Sweep Fade Hedge under the microscope. This is a pure price action approach. No moving averages, no oscillators, nothing but the raw candles. By the end of this video, you'll understand how it spots a tested level, how it fades a false break of that level, and how a built-in breakout hedge steps in when the level genuinely gives way. Let's get into it. So what exactly is the Shelf Sweep Fade Hedge strategy? At its heart, this is a mean reversion strategy that fades false breakouts at a proven horizontal level. The design calls that level a shelf, a region of support or resistance that price has bumped into more than once. The whole approach reads directly from the open, high, low, and close of each candle on whatever time frame you attach it to. There are no indicators involved at all, no moving averages, no relative strength index, no average true range. Every decision comes from market structure and candle shape. Here's the core idea. Markets often poke just beyond a well-tested level to sweep the orders resting there, and then snap back inside the range. This strategy is built to detect that snapback. When price spikes through a shelf but closes back inside, leaving a long rejection wick, the strategy reads that as a failed break and fades it, taking a position in the opposite direction back into the range. Now, fading levels has one obvious weakness. Sometimes a break is real and price keeps going. That's where the hedge comes in, and it's the feature that makes this strategy distinctive. If a later candle actually closes decisively beyond the shelf, the strategy treats that as confirmation the level has genuinely given way. It then opens an opposite position to ride the real breakout it was just caught against. In terms of markets, the design notes point to liquid, range then break instruments, major currency pairs like euro, US dollar, gold, or an index, on intraday time frames from 5 minutes to 30 minutes. As for who it suits, this is really aimed at traders who are curious about price action logic, market structure, and how an automated system can be coded to react to candles rather than lagging indicators. Remember, this is educational information only, not financial advice. And like any strategy, it can and does produce losing trades. Let's walk through the mechanics step by step. First, the strategy builds its shelf. Over a look-back window, 24 bars by default, it finds the highest high and the lowest low. But an extreme on its own isn't enough. The level only qualifies as a tradable shelf if price has reacted there before. By default, at least 2 separate bars must have come within a set tolerance of that extreme. A lone spike doesn't count. The strategy wants a level the market has respected more than once. Next comes the signal. On each freshly closed bar, the strategy checks for a sweep and a rejection. For a short setup, the bar's high must pierce above the resistance shelf, but the bar must close back below it. On top of that, it needs a dominant upper wick, by default at least 1.2 times the size of the candle's body, and that upper wick must be larger than the lower wick. That combination is a textbook rejection. Price tried to break higher, failed, and snapped back. The long setup is the exact mirror at the support shelf, a wick below support, then a close back above it. There's also a momentum filter. The signal bar's range must be larger than the recent average range, so only decisive, energetic rejections qualify. 2 optional filters can be switched on as well, a requirement for an engulfing candle and a requirement for a 3-bar fair value gap, which is a sign of displacement. By default, these extras are off. When a valid setup appears, the strategy fades it. A short sells back into the range, a long buys back into the range. The stop loss sits just beyond the swept wick, plus a small buffer. That's the price that would prove the shelf has truly given way. The take profit is set as a multiple of that stop distance, with a default reward to risk of 1.6. Finally, the hedge. While the fade is open, the strategy watches for a candle that closes beyond the shelf by a buffer amount. If that happens, the break was real, so it opens an opposite position to ride the breakout, with its own stop just inside the broken level. When the original trade resolves, any surviving hedge is closed, so the basket always returns flat, one clean cycle at a time. Let's look at the actual MetaQuotes language code, the way you'd see it in MetaEditor. At the top are the inputs. StructureLookback sets how many bars define the shelf. Touch tolerance points and MinTouches decide how close a bar must come, and how many touches are needed for a level to count. Rejection wick factor controls how long the rejection wick must be relative to the body, and reward risk sets the take profit as a multiple of the risk. The hedge has its own inputs: hedge-enabled, HedgeBufferPoints, and HedgeRewardRisk. Now the two signal blocks. For the short side, look at the two booleans. Short sweep is true when the number of resistance touches meets the minimum, the candle's high reaches the resistance level, and the close comes back below it. Short rejection checks that the upper wick is at least the wick factor times the body, and that the upper wick is bigger than the lower wick. When both are true, plus any optional filters, the code sets the entry at the bid, places the stop just above the swept high, computes the risk, and sets the take profit at the reward to risk multiple below entry. Then trade. Sell sends the order. The long side is the mirror image. Long sweep needs the support touches, a low that reaches the support level, and a close back above it. Long rejection wants a dominant lower wick. When those line up, the entry is taken at the ask, the stop is placed just below the swept low, and the take profit is set the same multiple above entry, before trade. Buy sends the order. Same logic, opposite direction. Let's bring this to life on the chart. What you're seeing is an illustration on the euro, US dollar, and I've drawn two horizontal reference lines. The support shelf down at 1.0836, and the resistance shelf up at 1.0896. These are our two tested levels, and everything the strategy does revolves around them. Remember, the strategy doesn't use any oscillator or moving average. It's reading the candles and these levels directly. Watch the first few candles. Price drifts down and taps the support shelf, bounces, trades back up, then comes down and taps that same support level again. That's exactly what the strategy is looking for, at least two reactions at the level, which qualifies it as a genuine shelf rather than a random spike. The market has now respected support more than once. Now comes the key candle. Price drops again, and this time it pierces below the support shelf. Its low pokes underneath the level, sweeping the orders sitting there. But look at how the candle closes. It snaps right back above support, leaving a long lower wick hanging beneath the line. That long wick is the rejection. The body is small, the wick is dominant, comfortably more than the wick factor of 1.2 times the body, and the move is energetic enough to pass the momentum filter. This is a failed break of support, and the strategy fades it. On the next candle, you can see the buy entry marker. The strategy goes long, looking for price to revert back up into the range. The protective stop sits just below that swept low. Structurally, the point that would prove support had genuinely broken. From there, watch price climb. Candle after candle pushes higher, back into the middle of the range, until it reaches the take profit target. Because the reward to risk is set to 1.6, the target sits a fair bit above entry, and price gets there. That completes the long trade. A sweep below support, a rejection, a fade, and a reversion to target. Now the chart flips to the other side of the range. Price keeps rising and approaches the resistance shelf up at 1.0896. It tags resistance once, eases back slightly, then pushes up and tags it again. Just like before, we now have a tested level with more than one reaction, a valid shelf to fade, this time from the short side. Then the mirror setup appears. Price surges up and spikes above the resistance shelf, its high poking clearly above the line as it sweeps the orders resting above resistance. But the candle closes back below the level, leaving a long upper wick stretched above the line. That dominant upper wick is the rejection. Buyers tried to break out, failed, and price was pushed straight back into the range. The break above resistance was false. On the following candle, you'll see the sell entry marker. The strategy fades the failed breakout and goes short, with its stop placed just above that swept high, the level that would confirm a real break to the upside. From there, price rolls over. The candles step down, away from resistance and back into the range, until price reaches the short take profit target, once again set at the 1.6 reward to risk multiple below entry. So across this single chart, you've seen both halves of the strategy. A sweep below the support shelf, a rejection wick, and a long fade back into the range, followed by a sweep above the resistance shelf, a rejection wick, and a short fade back into the range. And remember the hedge we discussed. If either of those breaks had been real, if a candle had actually closed decisively beyond the shelf instead of snapping back, the strategy would have opened an opposite position to ride that breakout instead. This is an illustration of the logic, not a prediction. Real markets are messy, and losing trades are part of the process. And that brings us to the end of our breakdown of the Shelf Sweep Fade Hedge strategy. We covered how it defines a tested support or resistance shelf, how it fades a false break with a sweep and a rejection wick, how its stops and targets are built from structure with a reward-to-risk multiple, and how the breakout hedge steps in when a level truly gives way. As always, this video is educational information only. It is not financial advice, a recommendation, or a solicitation to trade. Every strategy carries risk, and losses are part of trading. If you found this useful, please like the video, subscribe for more MetaTrader 5 strategy breakdowns, and drop a comment with the strategy you'd like us to analyze next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.